You know this, we have already recorded a couple of sessions on loan syndication, but this session would be one of the highly critical and important for you. Why? I'll tell you. In a loan syndication, usually you would have seen the loan purchase rate, which is 98%, 99%, 97%. But how this really impact and matters, so that you should know it. So I'll explain that in a very simple process. So if you see, in a loan, what happened, guys? Loan always the buyer purchase at the purchase rate, not at par value, because par value, which is something the borrower which has already borrowed amount, right? But borrower at the time of maturity will repay the full par amount to the lender, so who have lent the money. Okay, but this is something purchase rate, which is something because based on risk of a loan or default, the possibility. On the basis of that, basically market participants, they derive the value of current loan, which they apply basically discount or risk factor, and they decide the purchase price. And purchase price should be the actually the price of a loan which is trading in LST and LMA market, which is in a secondary market. So that price would be the actual trade price. Okay, but how it works, we'll discuss that in details in simple terms. So what is purchase rate in a loan buying? The purchase rate is the price at which a loan is bought, expressed as a percentage of the outstanding principal. Example, let's say borrower has 1 lakh outstanding on a loan amount. Another investor or lender buys this loan from the original lender, which is at a face value. If the purchase rate is 100, it means buyer pays full amount, okay, which is 1 lakh. 90%, it means buyer who's, buyer would be lender eventually, who want to lend the money to the borrower. So 99%, it means buyer pays 99,000. So which is something, the discount of 1%. And if you see the rate of 95%, it means you can see a discount on face value of 5%. It's like a bond. If you purchase bond on discount, still at the maturity, you get the full amount, right? So same logic applies here as well. Why would someone buy a loan at a less than 100%? Because of risk adjustment, market rates, and loan terms. And apart from this, the one more factor which impact, which is liquidity needs to the original lender. So that's what look for a quick sell at a discount. But how does it work in a simple way? Let's say original lender, which is a bank, sell the loan, right? The loan buyer, which is an investor, buys the loan from the market, and borrower, which is still owes the full loan amount and interest. Example, let's say original loan amount, which is 1 crore, purchase at 98%. Loan buyer pays 98 lakhs to bank A. Borrower continues to repay full amount, which is, borrower will have to pay full amount at maturity, right? 1 crore plus interest to the new lender. And the loan buyer earns, who have purchased the loan, interest plus 2 lakhs, which is extra, right? So it means the loan will settle at face value at the time of maturity. So the buyer will have a benefit of 2 lakhs extra apart from interest payment. So this is how loan purchase, guys, the rate works in this loan syndication process. You might expect questions in interview as well, like what is this purchase rate or how does it work? So you should understand this. So I hope this was enough. If you need a full session on it, comment purchase rate. So I'll explain more on this one, and I'll record full-fledged video on this as well. So thank you.